Welcome to the Explainer. Look, today we're actually going to skip the usual agenda and just dive head first into something that's going to absolutely shatter some of the biggest myths we all hold about wealth. We're talking about the incredible, honestly almost magical engine that builds true financial independence, the power behind compound interest. All right, let's just get right into it.
To kick things off, let me throw a classic trick question your way. If you had the choice, right here, right now, would you rather have $10,000 handed to you every single day for 30 days? Or would you prefer a single, kind of insignificant-looking penny that just doubles in value every day for 30 days? Really think about it. I mean, 10 grand a day sounds super safe, right? A guaranteed massive payout. But let's see how the math actually plays out.
And this brilliantly illustrates the whole point today. The answer? It's the doubling penny. No contest. If you took the 10 grand a day, you'd end up with a very respectable $300,000 at the end of the month. Not bad. But that doubling penny, thanks to the sheer mathematical magic of compounding, it yields over $10 million. Mind-blowing, right? The first few days, yeah, they seem agonizingly slow. But soon, gains beget gains, which beget even larger gains. It's exactly why compound interest is so often called the eighth wonder of the world.
Section 1. Wealth is not income.
Now, before we can really leverage the math of compounding, we have got to break down a massive fundamental misconception. See, most of us are completely conditioned to think that earning a huge salary is the only way to become wealthy. But there is a really stark contrast between living high and actually building true wealth. Think about it. If you make a stellar income every year, but you spend every last dime of it to live a lavish lifestyle, you aren't actually getting wealthier. You're literally just living high. True wealth, that's about what you accumulate and what you keep. And that comes mostly through hard work, perseverance, and some serious self-discipline, rather than just what you simply spend. In fact, research shows that a staggering 80% of millionaires are entirely self-made. They started with nothing but ambition and energy, just like most of us.
There's this amazing anecdote from the researchers behind The Millionaire Next Door that absolutely nails this point. They interviewed this guy, a Mr. Martin, for a focus group of people with a net worth of $5 million or more. Now, Mr. Martin is a self-made multimillionaire and an incredibly astute investor. But here is the kicker. Despite amassing a $5 million fortune, Mr. Martin never earned more than $75,000 a year from his actual job. Seriously, it wasn't his income that made him rich. It was exactly how he managed and, more importantly, grew the money he kept.
Section 2. The magic of compounding.
So how on earth do people actually build that kind of net worth without a blockbuster salary? Well, they use the mathematical engine of compound interest. Let's look at a classic example, Jack and Jill. Jack relies entirely on his own labor. He just grinds it out, saving $25,000 a year for 40 long years to finally reach his $1 million. Now, if Jack is earning, say, $50,000 a year, he is having to save half his salary. That is a grueling, almost impossible task for anybody. Then we have Jill. Jill takes a mathematical shortcut. She invests just one single dollar and finds a way to double her money every year for 20 consecutive years. By using the sheer power of compound interest, Jill also hits that $1 million, but she does it in half the time, with infinitely less initial capital. Now sure, Jill's 100% annual return is a theoretical example, but the underlying principle is absolutely what matters here. You have to make your money do the heavy lifting. Okay, so how do you know when your money will actually double in the real world? Enter a really essential mental model, the rule of 72. It's super simple. You just divide the number 72 by your expected rate of return, and boom, it tells you exactly how many years it'll take for your investment to double. So, for example, if you find an investment giving you a 15% rate of return, 72 divided by 15 is roughly 5. That means your money brilliantly doubles roughly every 5 years. It is just a fantastic, quick shorthand tool to gauge your wealth-building speed on the fly.
Section 3. Time is your best asset.
All right, we've talked about the math, but listen closely, because the single most critical variable in the compound interest formula isn't your job, and it certainly isn't your bank. It's time. Let's take two investors, Luke and Leah. They both earn a 12% return until they retire at age 65. Luke gets a head start at age 24, invests just $2,000 a year for 6 years, and then he completely stops. He only ever put in a total of $12,000. Leah, on the other hand, waits until she's 30 to start, and to catch up, she has to invest $2,000 a year for 36 straight years. That's totaling $72,000. But get this. Even though Leah invested 6 times as much money out of her own pocket, Luke still beats her. He ends up with nearly $948,000, while Leia sits at around $897,000. Simply because Luke gave his money 6 extra years to compound, he is our wealth-building hero. Investing early is literally just as important as the actual amount you invest.
Now, let's look at the other major variable, your interest rate. Imagine Luke has 2 sisters, Charlotte and Rose, and they both invest exactly like he did, $2,000 a year for 6 years starting at age 24. But Charlotte earns an 8% return, while Rose makes some pretty poor investment decisions and earns only a 4% return. Fast forward to age 65, Charlotte has over $253,000. Rose, she has less than $57,000. Even though they invested the exact same amount for the exact same amount of time, a mere 4% difference in that rate of return means Charlotte has nearly 5 times more money than Rose. It's wild.
Section 4, Dollar Cost Averaging. Okay, so now that you can see the sheer unadulterated power of the math and all the variables at play here, how do we actually practically feed this compounding machine on a regular basis without completely losing our minds? Well, the answer is a strategy called dollar cost averaging, or DCA. It was actually coined by the legendary value investor Benjamin Graham way back in 1949 in The Intelligent Investor. And DCA simply means investing the exact same number of dollars each month or quarter and completely ignoring what the market is doing. Why is this so brilliant? Because it automatically means you're buying more shares when prices are low and fewer shares when prices are high. It systematically lowers your overall average cost per share over time, and it totally removes the stress of trying to time the market. You don't have to guess when the market is at its lowest. Given its clockwork-like methods, constant emotional decisions become totally unnecessary.
Just look at the massive potential of actually sticking to this strategy. The data clearly shows that if you systematically use dollar cost averaging to invest just $500 a month into the stock market for 40 years, assuming a historical 10% annual return rate, you would end up with an ending balance of over $2.5 million. Let that sink in. It is the ultimate example of just letting consistency and time do the heavy lifting for you.
Section 5. Automate your financial future. So, this brings us to the final, absolutely crucial behavioral piece of the puzzle. How do we ensure the money actually makes it into our investment accounts without having to rely on sheer, exhausting willpower every single payday? Because let's face it, willpower fades. The solution is complete automation. David Bach, the author of The Automatic Millionaire, actually became a self-made millionaire by age 30 using these highly effective steps. First, aim to save 1 hour of your pay per day. For full-time workers, that works out to roughly 12.5% of your paycheck. Second, set up a pay-yourself-first automatic transfer. Literally have the money move directly from your paycheck into your investment and savings accounts automatically. Bach says that when that money is moved before you can even touch it, that is how real wealth is built. Third, automate and consolidate your bills so they are paid shortly after payday. That gives you a very clear, realistic sense of what cash you actually have left to live on. And fourth, look really closely at your latte factor. You know, those daily little splurges you don't really need. It's not at all about giving up everything you enjoy, but rather redirecting just a little bit of that daily bleed to fund your wealth engine.
Now, to really make this automation work, you kind of have to embrace a concept called the decade of sacrifice. If you stick with this automated plan and commit to working hard, spending less, and investing aggressively for a 10-year period, your financial life will become entirely unrecognizable. And yes, okay, it might mean sacrificing the Gucci mags, the Louis Vuitton, maybe those expensive vacations right now. But you have to realize you aren't just giving things up, you are actively buying time for your money to aggressively compound.
And here is the ultimate payoff. This is what makes that decade of sacrifice completely worth it. Right now, if you want a luxury item, you have to trade your precious labor, your actual time at your job, to buy it. But if you build your compounding machine, eventually your assets produce enough yield to buy those luxury items for you, without you ever having to trade your time again. I want you to buy the nice things from your money's labor, not your labor. That is the moment you transition to true financial freedom. It's how people become what some call part-time millionaires. They're working on their own terms, simply because their money is doing the heavy lifting. To really cement this concept, there's this incredibly impactful quote by Robert G. Allen that I just love. He asks, "How many millionaires do you know who became wealthy by investing in a savings account?" I rest my case. It's brilliant. It perfectly highlights the absolute necessity of putting your money to work in assets that actually compound at a high rate. Look, just parking your hard-earned cash in a low-yield checking or savings account, it's simply not going to get you to the finish line.
So, as we wrap up this explainer, I want to leave you with a final, slightly provocative thought. You've seen the math now.
You've seen the massive difference between the doubling penny and the flat daily payout. So you really have to ask yourself, are you going to keep working tirelessly for your money, or will you finally step back, automate your investments, and start making your money work for you? The strategies are all laid out right here, and the clock is always ticking on your greatest asset, time. Take action and set up your automated wealth engine today. Thanks for joining me, and keep learning.